Oh.
One of these three is not correct. Which one is it? How do you know?
I got a different
does your bottom line here add up to 300,000?
No, very close to that.
How far?
Like 1,000 and
Well, they're off the price too.
54. Yeah.
It should be like less than that. They should all add up to the same total, right? Because they all have the same total number of costs that need to be allocated out. So if your bottom line here, which is the one here, that doesn't add up to the total, then you're off. So it's a pretty good clue if you're ever doing one of these problems, like on a test or something. Make sure your bottom line adds up to the total number of dollars that needs to be allocated. Anybody needs to go through or want to go through the details of the direct method? Okay. Okay, who did it? Come on up.
With the direct method, we allocate the service cost directly to the production department, so ignore the percentage to each other. So with service department 1, it was 35% of the total cost went to production 1, and 35 went to P2. So that was 50-50 split. So 50% of 15,000 or 30,000 is 15,000, and the other half, 15,000, goes to production department 2. With service department 2, it was the allocation had been 20% to P1 and then 60% to P2. That translates into a quarter of the cost went to P1 and then 3/4 went to P2. So the total cost to allocate was 20,000. You had a quarter here, 5,000, 3/4 here, 15,000. Then some 20,000 to P1, 30,000 to P2, plus their direct costs equals 120,000 and 180,000 respectively.
Okay. That looks correct. Any questions on that? The key move on the directs is upping the ratio so it's at 100%. This is the key move right there. Okay, step method.
Thank you.
David, want to get it through?
Yeah, sure. So what I did here basically is that these were original costs. S1 was 30,000, S2 20,000, P1 100, and P2 150. We're supposed to start with S1, so we allocate 30% of 30,000 to S2, which makes this 20,000 to 29,000. And we already allocated 10.5 S1 P1 and 10.5 S1 P2. So now here we have the like S2 P1 P2 here. Now we allocate things from S2 into P1 and P2. So the way we do that is that we have 25% of 29,000, which is 7,250, and 75% of 29,000, which is 21,750. And then you have to add 10.5, and you have to add 100,000, 150,000 each one, and then that's how we got 117,750 for P1 and 182,250. Any questions?
All right, that's right. No question? David, why did you choose going from S1 to S2 on the step rather than S2 to S1?
I thought it better that was actually better like the structure there that we're doing first.
Okay.
Yeah, pretty much.
Okay. And also you get paid, I think, 30% going there, more than the 20% going here.
But if you did S2 first, like, would it have the same result?
No.
Oh, no.
I mean, I don't think any of them are going to be dramatically far apart, but you get a slightly different result. Now we got the this one right here. Okay. Reciprocal. We don't have the correct answer up on the board. See if we can figure out the correct answer. I need somebody with a calculator to help me. We have the correct model up on the board. Do you want? Come on up and we'll try to get to the correct answer together. Everyone know what this stands for?
Please excuse my dear Sally.
Really?
Parentheses, maybe phone text, division, addition, subtraction. That was something I learned.
Okay, guys.
That's why we got this equation here. That we make this equation, simplify it, break it down knots, get what S1 is equal to this number here. Then we take the answer for S1, plug it back into S2, we get what S2 is. So make somewhere here. Then take it, you allocate the cost to the different P. Have the 35% of the 38,98. You get these two numbers, then you take the 20 and 50% of the 27,660, and in these two numbers, then you add it up, you can correctly allocate cost, get the total.
So the process that they've done here is right. But we know there's something that's off here in the math. Because these don't have 300,000.
The first three systems are wrong. The first one should be S1 equals 30,000 plus 20%, right?
Is that what it was?
Yeah, 20%.
Okay. That, okay, let's see.
Yeah.
Let me just see the problem. That could do it to us.
Yeah.
Yes.
Yeah.
Plus 20%.
Okay.
You want to go through the math to prove it, or?
Yeah.
Okay, and then someone needs to calculate. Okay, so S1 is 30,000 plus 20% of S2, and S2 is 20,000 plus 30% of S1. Using substitution, right there, 20%, we're substituting this into here. So we're down to a one variable, one equation we like to work with. 30,000 is 20% of 20,000 plus 0.3. That's 1. 30,000. Now here's the number. 4,000. What's 0.2 times 70,000?
20,000. That would be 4,000. Yeah.
So this is 20,000. So this is 4,000. Plus this stays the same, 0.6 times S1. So it becomes S1 is 34,000 plus 0.06 of S1. Subtract 0.06 of S1 from both sides. So you isolate the variable. That's 34,000. And what's that number come out to?
36.
36.
170.
170.
70. Yeah.
Okay? And now we take that number, 36,170 times 23, going back to this equation, 36,170 times 23 plus 20,000. And what does that get you for S2?
30.
13,
30, 851.
851. Okay.
So that's what we now need to allocate out here. And we keep the original percentages, we don't up them because these numbers include the cross allocations. So what do we have for allocated to production departments 1 and 2 from S1 at 0.35? We'll do this.
1, 2, 1, 2, 6. 6. Oh.
Okay. And how about to S from S2 to the 2 production departments? 20% first.
6.1.
6
1.
and 18.510. Now, if we've done a decent job, that should add up. That's 1, 1, 8, 8, 3, 0. If I got that right?
Yeah. Seven, 1, 1. 1, 3.
8, 1.
No.
Yeah.
Yeah.
Yeah. Just because these two have to add up. Okay? We don't, this is not in the homework, this one, so you won't have this answer key somewhere. You want to take a picture of it? Feel free.
It is.
You almost done with that? I won't, I'm going to go on, so I won't erase this. So next break, if you haven't done doing it, you can use the next break to finish your math. Just to wrap up this half of our chapter. Thank you. Implementation challenges and ethical issues. As always, the method you choose is based on cost and effect. I think we've seen here that the differences are not substantial. They go from 120 to 118 approximately. So there are differences. And believe me, if you're getting more, you want it to be less. But you need to make sure that you're choosing a method that really matters at the end of the day. And again, this method gets dramatically harder as you add service departments. You need to have allocation bases that make sense. But it's all about incentives. At the end of the day, manager, if you do a lot of this management accounting stuff, so that managers are doing the right thing for the strategy of the company. As we've talked about, normal allocation, you want to use budgets rather than actuals. Because let's just say there were 3 product departments and one of them went out of business, or production departments, and one of them stopped using resources. the other managers would just get a bigger piece of the pie if there was no longer allocating among three, if you used actuals. That's not fair. Allocation, they're then being allocated from their service departments a much higher percentage, and that's, how the manager supposed to do anything about that? They didn't decide whether, the company was going to outsource painting to a third party or not. And then here, another important point is, as you're allocated, let's say from IT, and you say, you know what, I could go outside if I wanted to and get a lower IT cost myself. So you start to create management decisions. Do you let departments create a competitive environment with their internal resources versus the real world? Do you let them say, you know what, I know the external cost, I'm not paying a dime more than the external cost. And then that kind of messes up the whole allocation process. Because quite often, internal shared services are not as efficient as an outside company. There's a reason why people use ADP for payroll. They can do it more efficiently than you do it yourself. Why doesn't Goldman use ADP for payroll? Why didn't they now? Why didn't they? Not enough zeros in the system. Okay, ethical issues. And these are two very important ethical issues that may be important to your company and something you want to look at. The first, cost allocation. We saw three different methods, three different numbers. The net effect is how much gets allocated to end products. If those end products, some of which are sold to the government, and some of which are sold to private industry. Let's say you sell to private industry at a fixed price with a nice profit margin. You sell to government at a cost plus price. Well, which allocation method are you going to use? The one that allocates the most to the government's product. So you could do cost plus, and you'll get a higher price. So there are ethical issues on how you allocate, the allocation methodology. And customers will want to know that. They want to know that you're doing it consistently and fairly. And regulatory agencies will look into that. Which this does have impact on outside entities, not just internal management. And the second one, very important. If you're able to allocate across country boundaries, across borders, again, you want to increase your costs associated with products going to high tax-rated countries so that the profits are less. So that you pay, since the high tax rate, you will pay off your profits. You want to minimize your profits in those high tax rate countries. So you get favorable tax treatment. I mean, this is at least two companies, one from this class and the other class, maybe more, do this legally. It's legal as long as you do it fairly and consistently. But there are some companies that do serious business in the U.S. and pay close to zero taxes because we have a high tax rate. They want to get those profits elsewhere. Why there's talk, some Democrat Republican argument, both moving in the same direction. I think our marginal tax rate is whatever, 35, 36%. The Democrats are saying take it down to 28. Republicans saying that's not enough, take it down to whatever. Both realize you need to take it down, keep the profits here, increase revenues by having a lower tax. Okay. second half of this chapter, we'll do a little bit faster than the first half. It's important, but not as, we're not as focused on it. Yes. Joint products. When you yield more than one product from a common input, that's called a joint product process. Oil, crude oil is a good example. You start off with crude oil out of the ground, and you create gasoline, you create heating oil, you create kerosene, you create asphalt, you create a lot of things. You slaughter a cow, you create good cuts of meat, you create bad cuts of meat, you create offal. Everyone know what offal is? The insides. OFFAL. So you create different products from a single raw material. And so joint product cost is a process of allocating joint products. Some products are different cuts of meat, they're called products. And some products are what we call byproducts. That's the offal. Relatively small value compared to the other products. So you get rid of them, but at a lower value. And the chief characteristic of joint products is the process of taking this joint raw material and turning it into a series of products is kind of inseparable. You can't say it goes to one product or the other. It doesn't go to the loin or the. It's inseparable up to a point. After that point, there may be some additional processing that one product needs. Turning the remnants of oil into asphalt has some other things that happen after separation. But there are joint costs that need to be allocated among the products. And that's what we're focused on. How do you allocate the joint costs? And how many different ways do you think we can do this? Probably infinite, but how many are we going to go through? Three. The point where definitionally the point where you can now do separate things for each of the products is called the split-off point. And until that point, you can't make a differentiation between the products. After the split-off point, the costs are usually called separable costs. And the three methods are physical units, the easiest. The sales value and split-off, a little bit more complicated. And net realizable value, just a little more complicated. Okay, we won't use a cow, we won't use oil, we'll use tuna fish. So you have 14,000 pounds of tuna, unprocessed value of $16,000. Then you have a split-off point, where you take the best parts and you turn it into tuna fillets, a high-value product. You take the rest and you turn it into canned tuna. 2,000 pounds go there, 8,000 pounds go there. That's only 10,000 out of your original 14,000. The other 4,000 pounds byproducts, scrap, and waste. We're going to change this later, but for now. So 10,000 out of the 14,000 are useful. You could sell the fillets at $2.20 a pound and the canned tuna at $1.65 a pound. Okay? So how do you allocate the cost of getting it? First, we did the physical units method. Simply percentage of units. Take the cost by the percentage of units. This stuff you're assuming is worth nothing. You don't give this a value. So it's 2,000 and 8,000, 20% and 80%, but you ignore the stuff that was worth nothing. So the total cost based upon units is 3,200 and 12,800, or $1.60 a pound. $1.60 a pound in cost between the raw materials and whatever you need to do to get it ready for split up. Is this fair?
Yeah.
Well, we're saying that up to split off, it might take more money. You have to be a little more careful when you're cutting. So it might have cost more money. And you know what? Remember the value, right? The fillets are worth $2.20, and this is worth $1.65 a pound. But what if this was a little bit higher? What if this is $2.20 and this was, I'm sorry, what if it was, this cost turned out to be $1.70 a pound rather than $1.60? Are we saying we shouldn't rate the packaged tuna? So it's a little bit unfair to do it this way, just to do it on the units of pounds, because the products aren't worth the same amount. It should be probably done somehow on value of the product. You took the total cost, which started out at 15,000, with 16,000, the total cost, and you split it 20% and 80%. Well, you know it has to be 20% of the 16,000. So we have the units, which gives us proportions, the percentages, which you then take a percentage of the total. Okay, the advantage of the physical units method is easy. It's objective. Volume of output. It ignores disadvantage. It ignores the revenue producing capability. And for some products, it's very important. The different products have different measurements. Oil. Can you compare the volume of output of asphalt with oil? One's in barrel, the other's in whatever asphalt unit of measure is. No, pounds. That's it. So I mean, sometimes you just simply can't even do this because you're comparing apples and oranges. Okay, so the next method, relative sales value at split off. Not dramatically more complicated. So you take, instead of taking the volume at split off, you take the value at split off. However, this is only useful if you have a value at split off. At the point of split off, I don't believe asphalt is yet asphalt. It's some remnant of the oil refining process that then has to be converted into asphalt. So there's activity after split off to get you to the end game. So let's assume now we can for our 2 minute method. We know the units at split off, given. We know the price at split off, that was given. We therefore know the sales value at split off. A times B. You can create a percentage from the value at split off. So 4,400 divided by 1,760 is 25%. 13,200 is 75%. So now, remember this was 20 and 80% in the first example?
Yeah.
We're giving more weight to the tuna fillets because they're worth more per pound. So we're weighting them up. Now so after here, at the same process. 16,000 total dollars of cost. Split up 25.75 was $2 and $1.50. So now you have a different, probably a more fair allocation of those original $16,000. So that says you'll make 20 cents a pound on the fillets and 15 cents a pound on the canned tuna, based upon this split up. Compared to 60 cents a pound for the fillets and 5 cents a pound for the canned tuna. So relatively easy to calculate, not that hard, right? Costs are allocated according to the product's revenue. That's good. Make it a more fair allocation. Disadvantages, market prices vary. Sometimes it's hard to get your finger on it. You know, thinking about splitting up oil varies by the hour. And then you might not be able to do this method because you don't have a value of all your products that's split up. This model is good, but imperfect. The next model, net realizable value, is kind of an offshoot of this. Instead of taking the value it's split off, you essentially have to, because some items may not have a value split off, you take the final value. And if there's some extra work that has to be done between split off and end product, you figure out the cost of that extra work, the separable costs, and you subtract it from the actual value of those products that have separable costs. And then you have kind of an approximate value at split off. So you go backwards to create values at split off, and then you work from there. Do an example. Okay, our tuna example. Of that 4,000 pounds that we thought were useless, 3,000 of those pounds are going to be used in cat food. You have to process it, so you have to like grind up the bones and some whatever you do with cat food. And then those extra costs to get it ready to become cat food are $850 for that 3,000 pounds, which means that you can sell that cat food for $1.75, which interestingly is more than you're selling the canned tuna. But you had to do more work. But if I was a cat food person, I would just buy the canned tuna. That's the difference. Okay, so now we have more information in this example. Okay, so now we have, instead of 10,000 pounds to consider, we have 13,000 pounds. We have 3,000 pounds of cat food to think about. We have an end price, which you extend price times pounds, and you have the end value, which is $22,850. And we know that there was $850 of additional processing for the cat food. So what you need to do is subtract this $850 additional processing from the end sales value to approximate your sales value at split off. This says that you would be net even if you would have said at split off the value was $4,400, which is $5,250 minus $850. If you could have sold those $3,000, those 3,000 pounds of cat food at that point to somebody else who could process it, you would have sold it for $4,400 or more and been fine. Okay, so now you have your values at split off for your three products. Their percents, just based upon these numbers as a percent of the total, 20, 60, 20. Numbers work out real nice in this example. And so then you take the 16,000 original cost and allocate it 20, 60, 20. You haven't forgotten about the 850. You have to add it back in over here. Figure out the cost per unit of each of your three products. So your cost per unit for your cat food is the amount allocated plus its steppable costs, which gets you to 4,050. And you break it down that way. Okay? Net realizable value. Yes, sir.
Can we assume that the additional protected cost of 850 does not bring any cost? Because we just checked 850 plus 250. That means the sale value, all those additional values come from our calculation, say from today, and from now,
I think it does bring profit, right? We're saying that for allocation purposes, here's how we should allocate it. But at the end of the day, you have another 3,000 pounds of stuff that you're going to sell at $1.75.
that's actually twice before or after.
That's after. So you're saying in this analysis, it's breaking even.
Yeah. For the additional protection cost.
I think, well, the way to figure it out, and I think your math is right for this example, that you take the price times the number of pounds, or the price minus the cost times the number of pounds, which would be 60 cents times 2,000, 45 cents times 8,000, and 40 cents times 3,000. I compare it to if you didn't do the work, and I think you're right, it's going to break out even. So for this analysis. Does that concern you?
No.
No, okay, good. Okay. Brings you more value. Trying to rephrase the question a little bit in a way that makes sense. So you're saying that why would you ever even consider selling cat food when throwing it out will bring you the same profit?
I think that we calculate, we assume that all the additional value of the 400 comes from material. Now the profit eventually comes from because the list of charges, 850 directly from the sales value of 5,250.
Right, okay. So remembering that the purpose of this exercise is to get your allocations done. You are expecting that you'll make money off that $850. Otherwise, you wouldn't do it. I guess you could, if you could determine the incremental value in some way rather than the additional processing cost. You know, let's say we know we're going to make in $200 over, say, 50, and therefore we use 1,050. I guess you could use that number if you so chose to get back to different percentages. You could do that. Your point is valid. Anybody understand his point? His point is, this analysis assumes that you're not making any profit on the capital. You're just taking the incremental processing costs, bringing them back, rather than the incremental value you create after the separable costs. And we're using that incremental processing cost to figure out the ratios rather than the incremental value. And that's the value. That's a reasonable point. So there's a fourth method that we're not going to use. That is a good point. Okay? You want to do two of these or no? No. You have homework. I don't think you do any more of this, right? I was only going to do the direct, we're going to do the physical and the relative cells. The NRV is just relative cells with a little bit more work on it, as an example of homework.